Are we in the middle or the beginning of a multi-year or decade-long fundamental shift?
Well, first, happy Friday, Brian. Great to be with you again. And we do think it's values time in the sun right now. The 14-year cycle is an extended cycle, one of the most extended growth outperformance cycles in history. And if you think about why that happened, Brian, think about growth started to really take leadership heading into the financial crisis. Financials got hammered. And we had the slowest economic recovery in history the last decade. So investors paid a premium for growth. But really, growth and technology has really started to underperform for several months. This isn't a new phenomenon. We went overweight value earlier this year, and we think as we have above trend economic growth this year and next, that value will continue to outperform, and we still think there's some more upside there, especially with the financials, energy, materials as our three favorite sectors.
Wow, I do need to correct you on something though, Keith. We at Worldwide Exchange don't call it Friday. We call it we get to sleep the next 2 days day. So from now on, it's no longer Friday. It's sleep in the next 2 days. Otherwise, where should we then be investing? I mean, do we, dump the FANG stocks and buy FANG like Diamondback Energy? I mean, literally, do we dump iPhone companies and start buying oil companies?
Well, I still think there's some opportunities within growth. We're not saying, hey, move totally out of growth. And I would say within the growth area, the one area that still looks relatively strong is the communication side. So I wouldn't necessarily give up on that. I just think that we have more upside in things like financials. Let me give you an example, Brian. Financials just moved above the 2007 high. And over the last 13, 14 years, they've been compounding at a rate of 1%. And that's versus about 7% for the S&P. So we still think there's catch-up potential, especially as this economy recovers as a whole. And then you think about things like materials. Everyone's concerned, and we talked about this recently on your show, about commodity prices moving up. Why not benefit from that trend by being in some of these material areas? And then energy, people are going to still be driving. We're seeing more travel as a whole. And the energy sector has underperformed the broad-based market by about 80% over the last 3 years. So there's still opportunity, there's still upside, and we would be sticking with that trend and using pullbacks to get more into the value side of the market.
Yeah, we've seen, stuff done by Tom Lee at Fundstrat doing great work showing when the price of oil is at, whatever level, $65, oil stocks tend to be higher than they are now. But they've been dumped by institutional ownership. We know that. A lot of ESG funds say they simply will not own it. Is that underperformance and that unloved nature, could that be a benefit for those who can learn to love it?
I mean, that's right. I mean, the energy sector became the smallest weight basically in the history of the index coming into this year, and we've seen a sharp rebound. But the other thing that's important is it's not just a thesis saying, hey, these things are starting to look better. The earnings are actually stronger in these areas that I discussed, financials, materials, and energy, than any other area in the market. So meaning the upward momentum relative to the overall market is still strong. And that's also why technology has underperformed some. Early into this pandemic, technology was the only place to go, really, because these companies were thriving. But now there's a lot of catch-up potential in these other areas of the market. We just think there's more upside to go in here, Brian.
Shepard Smith here. Thanks for watching CNBC on YouTube.